Hey, good morning, everyone. Marty Missouri here, August 5th, 2024. Just thought I'd pop in and talk at you for a few minutes in light of what's going on in the market this morning. As I suspect all of you have noticed, if you've turned on the news today, that stocks are having a real rough go of it. It actually began last night in the overnight session in Asia and has taken us obviously through into the cash session this morning. S&P's down a bunch, 2.75%. Dow's down 850 points. It was down like 1,200 points at one time this morning. So what's going on? Well, folks, I've been preaching at you or lecturing at you for quite some time that stocks, both from a valuation standpoint and from the standpoint of just the macro environment, are in a pretty dicey spot right here. And so everybody's trying to speculate as to what's going on. Probably the most holistic view of it would be that, the economy is showing some signs of weakness. The market has been in the soft landing camp. And now and when I say it, traders and investors in the aggregate are now beginning to consider that, hey, maybe we do have a recession in the not too distant offing. And if we do, make no mistake, folks, stocks are not priced, not remotely, for the earnings hit that they will take during a recession. They are priced for rising earnings as far as the eye can see. That has not been a scenario that makes a whole lot of sense to us, understanding the cyclical nature of markets and economies and so on. So, another speculation that people are having today is what we've talked about before, and that is the, quote, yen carry trade, the yen being a pretty stable currency historically. You can borrow in that currency for virtually nothing. Let's do that, and then we can go invest in assets, lend money, yada, yada, in other currencies. Well, that's great until something breaks. And if something breaks and suddenly panic hits, well, then those positions need to get unwound and the money flies home to the safety of the yen or to, repay or to pay off that debt because they're concerned about what's going to happen to the currency valuations and so forth, because you can lose a lot of money if that goes against you. Now, I've shown you for months now, off and on, how the yen looked poised for a big breakout to the upside, is trading at virtually historic lows, probably the most shorted thing out there. A time or two I've showed you the position of traders here of late in the yen. So, essentially massive short covering rally in the futures pit, massive short covering with people repatriating those yen carry positions and so on. And so perhaps that's some of it as well, global selling of assets as this again, carry trade unwinds. As I showed you here within the last 3 weeks or so, sentiment got historically bullish, insanely bullish from an advisor perspective. I know I illustrated that for you, and I told you how good an indicator that is. Well, it was at pretty historic highs, and so that makes some sense too. Everybody was too much on the bull side of the boat. Something cracks, everybody goes screaming to the bear side by selling their securities. So there's those things. Huge volume in the options markets these days. We've talked about this a lot in the past. As, for example, put options, your basic put option in a stock, as that stock begins to decline and the holder of that put begins to make money, the seller of that put has to short the underlying security to hedge their losses. That shorting exacerbates the downside. So probably all of the above and some would be the excuse. At the end of the day, for our purposes, it's just what does the risk-reward setup tell us, right? It tells us, and it's been telling us for a while, not to invest in the manner that we did and enjoyed from early 2009 all the way up to the late summer, early fall of 2019. The whole time here was just a wonderful run. The 90s were a wonderful run. But, we've done the work over the years. I started in 1984 to develop our own indicators, our own signals, and then, of course, we leverage a lot of people who are really good at this stuff to help us formulate our own risk-reward views. And as I've said ad nauseum here for quite some time, you don't want to be fully invested in this market right here. You want to have ample cash, short-term treasury type investments on the sidelines for safety reasons, also for ammunition to buy with as things shake out. Hedge with options if you can. I think own some gold, own some long-term bonds, and so forth. If recession is coming, the Fed will not be able to save it. Now, I fielded one question this morning and had other discussions about that. Austin Goolsbee, one of the Fed governors, jumped right up before the market opened this morning and said, if the economy is hurting, we will fix it. Well, that is a bold, somewhat arrogant thing to say, that the Fed can simply control the economy and fix it with policy. They can certainly help asset prices. That's kind of what they're known for. Economically speaking, we'll see. I don't watch CNBC, but I'm sure those who are probably trotting in tons of people who are saying the Fed needs to cut, the Fed will rescue, don't worry, stay invested, buy the dip, or what have you. Okay, I'm very sympathetic to that, but I'm sympathetic during times when our recession light is not flashing. Like, for example, in 95, when the Fed cut rates, stocks responded nicely. 1998, we actually had Russia default on its sovereign debt. We had the largest hedge fund at the time, long-term capital management, go belly up. Stocks took a 20% hit, but yeah, the Fed did intervene, particularly with LTCM, that hedge fund, and stimulated and so forth, and kind of saved the day. Well, they were able to. Why? Because there was no recession looming. When the tech bubble burst, the recession happened, they were cutting aggressively, and stocks, there were some big 20, 30, 40% rallies in there. But before it was all said and done, the S&P was cut in half and the NASDAQ was cut by 80%. Right before the Great Recession, massive, aggressive rate cuts and a 60% decline. Call it, round it up, 57% in the S&P. Our recession light flashed right here. I did videos, said, folks, right here, the Fed reacts to this, probably see a really nice rally. We won't capture all of it because we're going to start getting a little more conservative. Recession hit right on cue, but it got to use COVID as an excuse. That allowed for something like 11 trillion when you add up the fiscal and monetary response. So the recession just couldn't happen amid all of that stimulus in the U.S. Did exacerbate very high inflation, and so we had a 30% hit in 2022 that the Fed really didn't respond to, other than rhetorically, no doubt, because they were fighting inflation at the same time. Inflation's beginning to cool. Some would suggest the Fed could have already started cutting because of that. I do think they're afraid of the early 80s where inflation ramped up. Volcker ramped rates up with it, created a recession. He panicked, cut Fed funds rate by like 10% over a few meetings, and then inflation came roaring back, so they had to ramp rates up again, and then we had a worse recession in 1983. So the Fed doesn't want to do a repeat of that, so there may be a little bit reluctance to come in with barrels blazing, but that certainly is what Wall Street is begging them to do. My concern is that you can see when we have recession, stocks need to reprice, regardless of what the Fed does. Speaking of that, how are stocks priced? On a price-to-earnings basis, I shaded the areas above 23 here, going back about 30 years, and you can see that when we sit up there, ultimately it tends to resolve somewhat negatively, right? 50%, 60%, 20%, 30%, and so on. The Great Recession, we weren't overvalued by our measures in stocks, but of course, residential real estate, consumer debt bubble, mortgage-backed securities, created a terrible recession. Stocks had to reprice because earnings came down big time, even though valuations weren't this high. These valuations say no recession coming, no earnings hit, and so forth. Maybe it's true, maybe they're right, but that's a dangerous assumption. Harder to manipulate sales than earnings, right? So I just showed you price to earnings, and yet what I'm implying there is if there wasn't for certain types of manipulation, that valuation would be even more expensive. Harder to do with sales. We were just off of all-time highs in 2021. Very expensive on a price-to-sales basis. Price-to-book value, what's a company worth when you square the assets and liabilities? Really, really close to all-time highs there as well. So, folks, doesn't mean that stocks are going to roll over tomorrow. Unequivocally, it does not mean that. In fact, stocks can stay overvalued for a very long time, years even. And somebody who's waiting for something bad to happen can miss out on a lot of gains. When you have a poor or a strained or sketchy, if you will, economic backdrop, that's where high valuations can resolve in something that can be very, very painful for those who believe that stocks just go up forever. So my message for today is that even though it looks like it could be a great buying opportunity, I'm sure people will rush in. I suspect that as the week goes on, you're going to get more and more Fed speak and more people coming out and saying, hey, the Fed's going to get aggressive here. You could see this market come back. Today's losses could get taken care of in pretty short order with a couple of good days. That's not what we're focused on. We're focused on this kind of stuff and the economic reality of the day, and also on the technicals. If you look at the monthly chart, this is a 30-year monthly chart of the S&P, it's got one of those patterns that tend to look toppy. It's called a rising wedge pattern, and we've broken down below right now that uptrend, right? When we square that with the momentum indicators, and we have this very high level bearish divergence on the moving average convergence divergence and on the relative strength index, which was showing overbought on a monthly basis. Overbought conditions monthly tend to not resolve well, particularly when we have confirming technical evidence like here in the MACD. You can see what the patterns were before those two massive drops that I show you here, and even before all of the corrections. So allow me to say it once again, doesn't have to resolve like it has all these other times, but history says we need to not get cute just yet. There could very easily be more to play out, and make no mistake, though, it's going to be very volatile in both directions for quite some time going forward. Folks, I'll leave it there. I'll talk at you again later this week. Thank you, as always, for watching and listening. Take care. Bye-bye.